closing entries. So we've gotten all the way through the accounting cycle, and now we arrive at the closing entries. So closing entries are typically done at the end of the year. It's a way for us to prepare our accounts for the following year, but also it must be done after all of the adjustments have been made to our financial statement. So this is going to be after the adjusting entries, then we're going to close. So the first thing that we think about or we talk about when it comes to the closing entries is the difference between the temporary accounts and the permanent accounts. All right, temporary accounts are what are we going to close? This is what we're looking for. Okay, temporary accounts are going to be our income statement accounts. Okay, and our permanent accounts are going to be our balance sheet account. All right, income plus dividends. I'll say that, dividends. All right, so income plus dividends. We are only concerned with our temporary accounts. With our temporary accounts, if they're permanent, they stay on the books forever. So we don't care. We're not going to close our temporary accounts. So we don't care anything about those. We're not closing those. All right, so we're never going to close our balance sheet accounts. We're only concerned with anything that is on the income statement. The reason why is because our balance sheet accounts, they're going to roll over from year to year. If we have an account receivable for $20,000 from ABC Corporation, they owe us $20,000. We're not letting them off the hook just because of the end of the year. Excuse me. So that accounts receivable is going to remain on the books until they pay it or until we have to write it off, whichever comes first. However, they don't get off the hook just because we're switching to a new fiscal year. The income statement accounts, that's different. We've already done our reporting on the income statement. We've already, if you remember from the other video with the relationships between the financial statements, we've taken the net income from the income statement, we've put it into retained earnings, and then it's shown up and it's already on the balance sheet, right? So we don't need these accounts anymore. We want to start fresh. We want to start the year with zero income and zero expenses. So we have to close these accounts. Now, if you remember, when we're talking about our income statement accounts, we have our expenses and then we have our revenue, okay? If you remember, the expenses normally carries a debit balance, right? And then our revenue normally carries a credit balance, right? So to increase revenue, we usually will credit that balance. To increase expenses, we will normally debit the balance to increase it. However, we want to close those out. How do you close something out when it comes to accounting? You do the opposite, right? So if we want to close out these expense accounts, then what we're going to do is just that. We're going to do the opposite. So let's draw a little line here. What's going to happen is we're going to end up debiting all of the revenues. So we're going to have revenue here for X amount and then another revenue for X amount. We're going to debit all of the revenues. Then we're going to credit all of the expenses because that's the opposite. That's how we get rid of it. So we have our expense here, XX, and then our expense here for XX. Then more than likely we're going to have, this isn't going to balance. Unless we broke even for the year, we had no net income, this isn't going to balance. The difference between our revenue and expenses, which is the net income, is then going to go into retained earnings. So wherever, we're going to have to use it as kind of a plug. So we're going to have to, let me see if I can slide in a little retained earnings here. And it's going to depend on whether or not, which number is bigger. Do we need more credits or do we need more debits, okay? So the retained earnings portion is really going to be dependent on what happened here. If this was added to 100, we have 100 total expenses and 200 total revenues, then we need more expenses, right? Or we need more credits, I should say. And so then the amount would be over here. However, if it's the opposite, if this added to 100, this added to 200 down here, that means we would need more debits, and so the retained earning amount would be here. Retained earnings, for the purposes of the closing entry, is simply a plug. It doesn't follow normal, well, what's the normal balance for retained earnings? It doesn't matter. It's a plug. You plug it wherever you need to make this entry balance, okay? All right, and then you do the same thing for the dividends. So dividends are normally going to have a debit balance. Dividends it is considered a contra equity account because it decreases equity. If anything decreases equity or decreases assets, decreases a liability, we call it a contra so-and-so account. So dividends is going to be a contra equity account, which means that normal equity accounts have a credit balance, right? That's a right side account, credit side. Dividends, because it's a contra, means that it's normally going to increase with a debit. Okay? In order to get rid of this, we have to credit dividends. All right? For however amount. And then we're going to debit retained earnings for the same amount, okay? So this is kind of like the first entry. This is like the second entry right here. So you're going to have one to close out your revenues and expenses. Then you're going to have a separate entry to close out your dividends. All right, so remember, you have to figure out first, okay, what is the normal balance for revenues and expenses? What's their normal balance? Okay, their normal balance is this. How do I then get rid of that? Then you're going to do the opposite to get rid of it. Closing entries can be the easiest thing, but a lot of people get mixed up because they don't understand the normal balance. So you have to understand what is the normal balance first in order to close it out. All right? Questions? Let me know. Comments, likes, shares, all appreciate it. Thank you so much.